All right. So, as usual, just reminders of where we stand in the class right now. Your chapter 15 homework was due on Tuesday. We all know that. I've sent out emails, and obviously we spoke during class. I had also extended the deadline to 8 p.m. We're in chapter 17 now. We're going to continue working through examples of statement of cash flows. And your homework for chapter 17 will be due in a little while to give you. Normally people need some time to really get their mind around statement of cash flow. So I've given you, a fair amount of time to get the homework done. I really encourage you to do this homework. There will be a full statement of cash flows on the test. And there will also be a statement of cash flows on the final exam. So, I think today's the 11th. You've got like 12 days or so to get this homework under control. And I just want to make sure that everybody is actually doing it. At this time of the semester, it gets a little bit crazy with everything going on. So it's possible that you could be feeling like you don't have enough time or whatever, but please, I'm really asking that you make sure that you do the cash flow homework. It's going to be a big part of the grade for the next test. All right, and then this is still coming later on, but the Tuesday before Thanksgiving, the next test opens is chapters 15 and 17, and it closes the following Tuesday. Right, so get ready for that. After that, we've only got about a week to go, and then we'll be done with the class. And the finals will start on December the 9th, and you have about 5 days to get that out of the way. All right, so you can see your grades on Wiley Plus. The other thing that I was going to talk about, that I think it was Shafak that asked me about the extra credit. One of the questions, remember, we have this optional extra credit of 10 points that's already available. Shafak, I don't know if you're on the call, but I did speak to the Wiley rep about why you couldn't get to the B and the C part of the question. Okay, I'll answer that question in a minute. Why you couldn't get to the B and the C part of problem 13.1a? It's actually a problem it was actually a problem in Wiley Plus. So thank you for bringing that up, because it seems that you guys don't really care, but I'll just tell you what happened. It seems that even though for the overall assignment, I put that you could submit, your parts as you go along. For some reason, the system has a separate section where the question has its own settings. I didn't know that. Like, the question defaults to its own settings, and those settings could be different from whatever I put in as the settings for the assignment. So and also because it was unlimited attempts, the Wiley rep told me that even if your answer for A was correct, because of the way the system defaulted the settings on the question, we basically had to fix the settings, which we did do. And we ended up finally hopefully resolving that. If anyone's doing that question, or Shafak, if you're on the call, just go ahead and check that you can actually get into the B part. Okay, so anyone doing the extra credit at some stage, you should be able to answer all the multi-part questions appropriately. All right, so that's where I will leave that. Or I think the admin, I don't think we really have any other administrative stuff that we need to talk about, unless someone has any questions for me. Oh, right. So the chapter 18 is financial statement analysis, and the chapter is predominantly based around calculating formulas and explaining what they mean. So, it's formula driven. It's chapter 17 is very different from chapter 18. I would say that chapter 17 is a lot more challenging than chapter 18 to answer that question that was in the chat. All right. So where we left off last time was that we were working through the net cash provided by operating activities, or the operating activities section of the statement of cash flows. And what we found was that we use the indirect method, right? That's what we understand from the theory and from the textbook. The indirect method means that you start with net income as the first line on the cash flow from operating activity section, and then you have these adjustments that you need to make to that net income, because the net income is based on accrual basis of accounting, which means that we record the transactions as they happen, and we record revenue when it is earned and expenses when they are incurred. It doesn't matter if cash has actually been received or paid. And because we're going from net income that is not cash basis, but we want to know how much cash the company has actually generated from its operations, we need to make adjustments to this number to get to a cash basis. And again, the importance of this is, of doing this, is that it's possible to be in business and seem really profitable, right? It looks like you are doing really well because you are generating all this revenue and you're trying to contain your expenses. But if you don't have actual physical cash in hand, it doesn't matter. You won't stay in business very long, right? That's the reality. It's the same in our lives, right? You can have a really good job. You just started the job, today, and things are looking great, you're going into work and so on, but when do you get paid? You only get paid at the end of the week, or at the end of 2 weeks, or at the end of the month, depending on how the payment schedule works at your job. So you can say, yeah, I've been working for 2 weeks and I've earned all this money, but until you see the deposit going into your bank account, or until you receive a physical check from the company, you don't have cash. And if you work for 2 weeks and at the end of the 2 weeks they say, we don't have the money to pay you, then your accrual basis income says that you earned 2 weeks worth of pay, but your cash basis tells you that you have $0 in your hand. So I hope that makes sense to everyone, why we have to go through this process, because investors, banks, even the company themselves want to be able to see how much cash they actually generated, not just how much profit they have. And profit is not the same as cash if you in a big company that is operating on the accrual basis. It just won't be, because there will always be some mismatch between accrual basis and cash basis. Again, it's indirect method because you are not starting with saying cash received from customers. If you look in the appendix, which is outside of the scope of C, you're asking this, if you look in the appendix, and that's outside the scope of our work, but if you look in the appendix, you'll see the direct method of the cash flows, and it literally says cash received from customers, cash paid to suppliers. That's direct, saying this is the exact amount of cash that we received and paid, whereas this is indirect because you are starting with something that is not cash basis. You're starting with net income indirectly and then working back to a cash number. And as crazy as this approach may be, you think, well, isn't it easier to just say cash from whoever, and it must be much faster? The direct method is actually much harder to do. And on top of that, if a company decides to use the direct method, then they still have to show in their footnotes the indirect method, how they get from net income to net cash provided by operating activities. And as a result, most companies just use the indirect method because they're like, what's the point of doing the direct method when we have to show a reconciliation of the indirect method anyway? So this indirect method because we start with net income. All right, so 153,000 was where we started. This was a number that was given in the question, and that's how your questions will generally go. They'll give you a net income number. That's where you start, always the same starting point. Then you have these adjustments, right, that we spoke about, the adjustment to reconcile that accrual basis of net income to net cash provided by operating activities, and there are 3 adjustments. And so you can basically, if you want to almost like memorize what they would be so that you can go looking for them in a question. The first one is that we add back any non-cash expenses. And in this case, we're talking about depreciation expense or amortization, is the depreciation for intangible assets. So, there's depreciation expense that, or amortization expense that you add back. Then in the second step, you want to remove any gains or losses that relate to investing and financing activities, because those numbers have already been included in the net income. But you don't want them as part of operating activities. You want to put them into investing or financing activities. So, as discussed in the notes here, you do the opposite of what you would usually do with gains and losses so that you can remove them from net income. So you deduct a gain, right? Normally a gain is added to get to net income. You deduct the gain so that the impact of the gain is 0. And then you can go and deal with the gain separately in investing or financing activities. And you add a loss, again, because a loss would have been subtracted to get to the net income number. So now you add it so that the impact of the loss is 0. And then finally, we have this third adjustment where we say, what happened to our current assets and current liabilities? Did they increase or decrease? And depending on whether they increase or decrease, you either add or subtract the impact of that increase or decrease to or from net income. All right. So we use that guideline to be able to build this. And in the end, we had net cash provided by operating activities of 168,000. All right. And when we finished, I know we finished with Rojas, and I'm gonna just highlight the differences here. What happened with Rojas was that we actually had a loss that we had to add back in Scoggins. We didn't have any losses or gains, but I just showed that piece. And then, of course, as you know, from the, that was kind of the end of the class on Tuesday, we actually went through and finished the investing and financing activities. And we found out this is number 3 on the handouts, right? We found out that for the sale of land, and so just to revisit the investing activities for that question, right? We found out that land was sold, land that had a cost of $6,000, right? The number dropped, was sold for $4,900. And so we know that actual cash that was received is $4,900 over here. I showed you guys how the journal entry would look. And then there was issuance of stock and the payment of the dividend. And then, just to revisit what happened here at the end, because we were also close to the end of the class, and I want to make sure that people actually understand how you finish off the statement of cash flows. You take the net cash provided by operating activities, the net cash provided by investing activities, and then this net cash used by financing activities, and it's used by because it's a negative number. So A plus B plus C gives you the increase or decrease in cash for the year. So it's an increase of 3,600. And we said that makes sense because you can actually tell what the change in cash is by looking at the balance sheets, right? The cash here went up by 3,600. So you know that once you finish doing this calculation, your change over year should be the same as the change in the cash number on the balance sheet. And then you put in the beginning cash number, the 10,700, and then you get to the cash at the end of the year. And so again, what's convenient about building a full statement of cash flows is that you have to end on the same cash balance as what you have on the balance sheet, right? 14,300. So you've explained how cash changed from 10,700 at the beginning of the year to 14,300 at the end of the year. The change is 3,600, but look at all the things that make up that change, right? It's like what I said to you guys when I said if you saw that your balance on your bank account changed, from $500 to $900, you know that $400 increase, right? But the increase can be from all kinds of ins and outs in your account. It's the same with the statement of cash flows. Just because there was a change in 3,600 doesn't mean that, this all relates to just like one check where someone paid us 3,600 and that's why our balance went up. There are multiple, right, transactions that got us to that point. Okay, so that's kind of a recap just to situate us again, back into the material. Does anybody have any questions right now on this example before we move on? And just to warn you for the next example, which is number 4, it's a very short example, but I'm going to have you guys calculate the cash provided by operating activities. So any questions for now? Okay. So what I'm going to do now is, for those who have this page, you can look at it yourself. But if you don't have it, this is the question that I'm talking about. That's very short. I'm just trying to make sure that you guys know how to do the 3 adjustments that we were talking about. And let's read this, and you can, I'll give you some time to set up your own cash flow. So Talfa Inc. reported net income of 2.8 million in 2014. So there's your net income number, right? Depreciation for the year was 160,000. Okay, so we know that there's 3 adjustments. The first one being adding back non-cash expenses, depreciation expense being one of those. Accounts receivable decreased by 350,000. So accounts receivable is a current asset. So if a current asset is decreasing, you can go back to the rules and remind yourself what happens when a current asset decreases. You add or subtract, right? And accounts payable decreased by 280,000. Compute or calculate the net cash provided by operating activities using the indirect method, right? So I'm going to give you a minute here or 30 seconds or whatever for those people who still don't have this document in front of them. Take a picture or write down the information from now till 10:56. And then after that, I'm going to give you guys some time to actually do the question. All right. So, figure out how to get a copy of this, because I'm not going to leave this up. I'm going to leave up an example of a cash flow that you can use to guide you. All right. So that's the time. So now I'm going to put up the example of the maybe this one is a little bit, this previous one. Let's see. Yeah, okay. So I'll put up this one as an example of cash flows from operating activities section. So what you are going to do now is build your own cash flow from operating activities and using the information from exercise 4. And let's say you have 8 minutes, because it's not a lot of information. So we'll go until 11:04. Okay, 11:04. I'm going to just finish taking the attendance while you guys do that. Right, 3 more minutes to finish the operating activity section for number 4. Right, so we're at time. So does anybody want to walk me through your answer for exercise 4?
I started, but I'm not done.
Oh, okay,
I
so
can
no,
try to do it with you if nobody
are there
else does it.
other people who need more time? I'm happy to give more time. I thought I was being too generous. We can go for another 3-4 minutes. No problem. 11:08. Okay.
Okay, thank you.
So anybody who hasn't started, please find the question, get going. Part of making sure that you understand what's going on is actually doing the questions and not just waiting for the answer, okay?
Okay, now I'm done.
2 more minutes, just in case some others are catching up, okay?
Mhm.
All right, let's go. See, what do you want me to do?
Okay, so first you go cash flow from operating activity. Yeah,
Okay. So that's a heading, okay.
and then net income first.
Mm-hmm.
It's 2.8 million.
Okay.
And then we do adjustment one, depreciation expense.
So I'm just gonna put that long thing, adjustments to reconcile. Let me just copy it from above. Okay, so we put adjustments to reconcile, blah, blah, blah. And so the first adjustment is, sorry, depreciation.
Mhm.
What
Yeah,
is it?
depreciation expense.
Mhm. Okay,
160,000. And okay,
mhm. Yes, that's added back. And now what next?
and now adjustment two is
Mhm.
losses or gains, but we don't have any, so we're gonna write
Mhm.
zero.
Okay, so just to remind ourselves, right, that we in Wiley, you're not gonna have to do the zero, the zero thing because they won't have space for it. But for our learning, it's good to just have this in to remind ourselves that we need to do this. Okay, then the adjustment number 3.
Decrease in what was it? Account receivable of so we're gonna do plus 350,000.
Okay, so you're going back to, I'm just gonna scroll up
The
here.
adjustment.
Going back to the adjustment rules, you know that a decrease in a current asset you're adding. And this also makes sense because when accounts receivable is going down, it really means that we are collecting money from our customers. It's 350,000, right?
Mhm.
Okay. And then what else?
And decrease in accounts payable. We're gonna take off to 80,000.
So that's a subtraction. And that's because we are paying accounts payable, so that means that money is actually going out. Right, that's kind of a way that you can think about it. If the accounts payable balance goes down, it means that you're paying off your debt, so you have to subtract. Accounts receivable goes down, it means you're collecting money from customers, so it's an increase. These changes have not been accounted for in this net income number. Okay, so are we done? Is that it from an adjustments perspective?
Yes.
All right.
And then net cash provided by operating activities.
So I'm first just gonna do the adding up this stuff here. It should come to, let me double check that, 230,000, right? Is the subtotal over here. And now we'll do net cash provided by operating activities. And you're adding the 2.8 million and the 230,000, so 3,030,000.
Mhm.
Questions? Anybody do anything different?
Actually, I have a question.
Yeah, go ahead.
Because I kind of like doing it like a robot. I just follow the steps. But can you explain again why we add the depreciation expense and why like the way you explained before with the why do we add the decrease in accounts receivable and we subtract the decrease in accounts payable?
So
Like
you have
what's
to,
the idea behind it?
you have to go back to what happens in an income statement. Let's just talk it through again, okay? An income statement, you have revenue, which is stuff that's being added. Oh, sorry, hang on, let me do this differently. Revenue, which is, right, all things that are being added. Expenses are all things that are being subtracted. Within those expenses is depreciation, right?
Mhm.
Expense. So depreciation expense is going to be a minus. To get to net income, you're gonna have to subtract depreciation expense at some point. And then, so these are, major categories. And then you've also got gains, right, which are an addition, and losses, which are a subtraction. Oh, sorry, which are a, what am I doing? Are a subtraction. All right. And within that, you would have any, like, let's say example, what we had, right? The loss on the sale of land in that previous, I know we don't have a loss here, but I'm just saying that would be a type of thing that would be included in this thinking here. So in the end, all these adding and subtracting and so on, that's going to equal net income, right? Net income is going to be the final balance at the end of all this plussing and minusing. And what we have in this example is 2,800,000, right? That's where we end. To get to this end, you must have already subtracted depreciation before, right? You must have said minus 160. Let me do this, minus 160,000 to get there. So because you said minus 160,000, you made net income smaller than it should be because depreciation is not paid. Sorry, it's not paid in cash. So subtracting something that's not paid in cash means that, this number is not close to the cash that we actually generated. We need to get rid of this because it's not a cash payment. Remember, we're going from an accrual basis to cash basis. So we want to remove anything that's not cash related. And so, so that's why depreciation gets added on, because what you do then when you add it on, you're going to say plus 160. Oh, sorry, we were tapping the wrong line. Plus 160. So the net effect of that is going to be zero, which is exactly what you want. You don't want depreciation to even come up as a factor, right? This minus and this plus gives you zero. And that's where you want to end up, because depreciation is just not a cash event. Why? Because the journal entry is debit depreciation expense for the 160 and credit accumulated depreciation for the same. All right. Nowhere is cash involved. So this thing shouldn't be decreasing our numbers to get to cash. It shouldn't be increasing. We should just not even account for the impact of it because it's a non-cash expense. We good on
Okay.
depreciation. All right. Now with the gains and losses, you can see that there are already things being added and subtracted to get to net income. Again, I know in this example we don't have gains or losses, but they will come up and the thinking is the same. You are adding a gain or subtracting a loss to get to your net income number. But these items belong in either investing or financing activities. Okay, that's activities. That's where they need to be. They do not need to be in operating activities. But when you start your operating activities, you see that they are already included, right? Because you are starting with this ending number. So because you started with 2.8 million, any gains or losses have already been added or subtracted. You need to get rid of them out of operating activities because you want them to be able to go into investing or financing activities, depending on, what or how they what they are, let's put it that way. So as a result, because there was already a plus here and you want the impact in operating activities to be zero, what you're going to end up doing is minusing again, because then the net impact is zero, right? This is impact on operating activities, right? The impact is going to be zero. Similarly, because the loss was already deducted, but you want to get it out of operating activities, you're going to have to plus so that the net impact will be zero. And that's why we add losses back. And this is what we do in the operating activities section. We add back the depreciation because we already subtracted it and we want the impact to be zero. We subtract gains because we had already added them to get to net income and we want to get to zero. We had deducted losses to get to net income, so we need to add them to get to zero, because these things should not be part of the cash calculation, because in the case of depreciation, it's not cash. In the case of the gains and losses, the cash impact will be accounted for in investing or financing activities. All right. So that's the first two adjustments. That's the thinking behind. And for the people who are like, the heads are exploding or you're rolling your eyeballs at me, even though I can't see you, remember you can always just revert to just following the robotic, like we said, right? Like a robot, just follow the instructions. But it is important, especially for those who actually want to know what's going on. It is important to see that there's logic, to this. And so that's where we finish with those two things. Do you have any clarification questions for me on that before I talk about accounts receivable and accounts payable?
That makes sense.
Good. Okay.
Yeah.
So now what ends up happening with accounts receivable and accounts payable, remember that revenue is already in net income, right? But revenue is any revenue, whether accounts receivable or received in cash, right? It's any revenue that any revenue that we earned is included in that number. And so now already you can see that there might be a mismatch, because remember we're concerned with cash, like what was the actual cash that was received. So because the revenue number may include stuff to do with accounts receivable, we have to go and look at accounts receivable to see what was collected for the year or what wasn't collected for the year. Because when you look at the collection of accounts receivable, and I'll just write it over here, right? The collection of accounts receivable, this is stuff that you guys did in accounting one, if you remember back in the day. Basically, what's going to happen when you are collecting accounts receivable, let me just bring this down so it's obvious that the journal entry starts here. You're going to say debit cash. And in this case, it was 350,000 that we collected. Debit cash and credit accounts receivable, right? That's how the collection journal entry goes. Now notice that in that journal entry, revenue does not come up at all, right? the revenue was already previously recorded when you said, debit accounts receivable, credit revenue. So this transaction, this collection was not accounted for in net income, right? It just wasn't, because net income is not going to pick up this cash transaction. It would have just picked up the actual revenue generated. So we have to add this back, because we are saying when we collect money from our customers, right, there is an increase in cash that is not accounted for in net income, right? Cash is going up, but that journal entry tells you it's two balance sheet accounts, right? This is a balance sheet account. Cash, it goes onto the balance sheet, right? And similarly, accounts receivable is also a balance sheet account. So there's no income statement accounts involved in this collection journal entry, which means the collection itself is not accounted for in net income. So we have to add this amount on because it never showed up in net income. Does that make sense?
Yes, very much.
Okay. Now we come to payable, right? Why is the payable a decrease, right? So I'll bring this across. And if you remember one, this is, I think I forgot to say this on Tuesday. If you remember the change for one current asset, like if you just remember that a decrease in accounts receivable is added, then every other current asset is going to be the same. So if inventory decreases, it's also an addition. If prepaid expenses decreases, it's also an addition. Anything that is a current asset at that point, you will remember now that you have to add it. So you don't have to memorize individual current assets, how do they move, because they all move in the same direction. You just have to know what is a current asset, okay? And in the previous example, I think it was example 2, we had a number of them that showed up: accounts receivable, inventory, prepaid expenses. Those are all current assets that we would account for. Now, with the decrease in accounts payable, it says that it is a minus. So this is a payment a payment of accounts payable is what would cause the balance to decrease. Remember, accounts payable is a liability, right? So when our balance goes down by 280,000, it's saying that we took cash out of our pocket and we actually paid down the liability. So the way the journal entry looks is you're saying accounts payable, right? 280,000 debit, and cash is the credit. Okay, cash is the credit. Notice here that this is cash going down, and these are two balance sheet accounts. It's the same idea as with the collection of accounts receivable, in the sense that these are both balance sheet accounts. So this payment, I'm writing almost the same thing, right? This payment of accounts payable is not accounted for in net income. There are no income statement accounts involved in the journal entry. So it won't come up in the income statement, right? When we pay money, right, or when we pay off, let me put it differently. When we pay off our liabilities, I don't want to say just to suppliers, because it could be other people, right? When we pay off our liabilities, there is a decrease in cash, which is not accounted for in net income. So that's how you think about the situation, that when we pay off our liabilities, we credit cash, we debit the liability, whatever it may be. Accounts payable is just an example here, but they were in the other example, we had accrued expenses as well, right? Accrued expenses payable. There could be interest, interest payable. There could be income taxes payable, anything payable, right? So when we pay it off, when it decreases, there's actually cash going out that doesn't show up in this 2.8 million, right, in this net income number, because none of these accounts are income statement accounts. So you have to add it back. So that was the the detailed, I hope you don't regret asking me, that was a detailed explanation of why we're doing what we're doing, for the people who want to know the logic behind this.
Yeah,
And
now
you-
it all makes sense. It's
Mhm.
just like so much easier. So the depreciation expense and losses and gains are in the income statements. That's why we need to bring it back in a
Yeah.
way. So we do the
Yeah.
opposite
Yeah.
action.
Yeah.
And then the everything that is asset or liability
Mhm.
is going to be in the balance sheet.
Mhm.
So we do the direct action instead of
Mhm.
the reverse action.
Exactly,
Yeah.
because it never showed up in the income statement to begin with. So now you have to actually account for the change in the cash balance that was not accounted for in net income. Exactly.
Yeah, I feel so stupid. Why didn't I understand it before?
It's not easy. Don't feel don't
Now I'm like,
no.
oh, that's why
No,
we did everything
don't
till
yeah,
now.
don't ever say that. Cash flows is very hard to understand.
But now it sounds simple.
Yeah, but the thing is, it might stick now, but then when you start doing examples, you and this is what we'll keep doing. I mean, we'll have a break in a minute, but I'm just going to keep plugging away at it. The only way for us to get comfortable with this thing is just to keep doing it, because it does. But once you have the clarity of why we're doing it, you can, like you're saying, it starts making a lot of sense and it becomes simpler. But it's also, you kind of have to hold on to the explanation a little bit initially, because there are many things that you have to remember to successfully complete, the statement of cash flows. So I'm happy to continue to reinforce, these points as we go along. And for the people, again, right, don't feel bad if it sounds like I'm, speaking in a foreign language or something. If you are committed to understanding this, you will understand it, okay? Because I will continue to explain it. But if you really are feeling overwhelmed and you're like, oh my word, do I have to know all of this to successfully complete the cash flow? Not really, because you do have this cheat sheet, to follow. But just remember, when you start memorizing things without truly understanding what they mean, if you swap something in your mind by accident, you won't sometimes realize that you are making a mistake. Okay, so I'm okay with people just using the cheat sheet and saying, okay, well, I'm just gonna go by the sheet. I don't know what I'm doing. I'll just be a robot. That's okay, but remember that you have to be very careful that you're following the sheet to the T, because if you suddenly decide to subtract depreciation expense because your memory went faulty or whatever, then you're doing the wrong thing. Okay, so try a little bit to understand what we're saying, but please don't become so overwhelmed that you shut down. I know how easy it is to shut down, especially in a class like this. You're like, this information is coming at you at a very rapid pace. Let's take a brain break now until 11:40. People can kind of have things sink into their minds, or you can just go and cry in a corner somewhere if you want. I'm joking. And we'll come back at 11:40. I saw some people join that I had previously marked absent. Shimon, I saw you joining. I just want to, before we break, is Wen Chen on the call? Wen, are you on? No. Rebecca Perez? Okay, so what about Courtney Simeon? All right, so Shimon, you're I think the only
I'm
person.
here.
Courtney, was that you?
Yeah.
Okay, so people are coming in and out. I just want to make sure that I'm not missing someone's attendance by. And Andrew, are you here? Andrew Nurse? No. Okay. All right, folks. So 11:40. John, I know you want me to talk about Math 117, so I'll stick it out. Yes, thank you for reminding me. I actually forgot that I had to go over chapter 15 homework. In fact, I'll go over it here in the second half of the class. So you guys are on break. John, if you want me to still talk about Math 117 and 15, I'm here.
Yes, Professor. So I was looking at it, and I did see one difference. So
Okay.
apparently you have to have a certain score to take 117. That's the only
Yeah.
difference.
Yeah, that's what I thought, because that's what I remember. But did you ever take a math entrance exam for the college?
Yeah, I took the math entrance. I failed it before they had all these things. So then I ended up taking math 99 and
Oh, so you
so
already took math 99 and you passed that?
yes.
Then you should be going into 115. Let me just see what's happening. I'm just gonna try and remember now where to look. This is gonna be brutal. I don't know what page this is on, because math, okay, let me look, see if I can find a table of contents. All right, let's check here. What page is the math stuff? Bear with me.
Mhm.
Professor, I think it's on the right side.
Why can't I see it? Where do you see it? Why am I like, I feel like I'm having some type of mental malfunction here. Where do you see it?
Can
Shafak,
you? Yeah.
under
It's
liberal arts or what? No,
yeah, liberal arts, mathematics, and science, and then below it, it's applied mathematics
got
option.
it. 72, although I don't even know if that's the, I mean, he's not doing applied math, but so page 72 supposedly. Okay, yeah, good. Thanks, Shafak. You say, oops, what did I just do now? You saved me because it's like not thinking straight or something. All right, so math, let's just look in the catalog to see exactly what is going on with math of 117. Okay, so there's 115. Your prereq is math 99, which you already did. So you're in good shape. Yeah, see, math, do you see what I meant here? 7 hours versus 4 hours, because this thing is supposed to be a combination of like a basic skills math, like a 95 or a 96. Well, this in any case is 95. I think 119 is 96. You need to register for 115, John, because you've already done 99 successfully. So you don't want to go into a 7 hour a week course when you have already I don't want to say tested out, but you've already finished things that you would have needed. So there's the three maths, right? So there's the 119, which is the 120 plus 95. Then there's the 117, which is math 115 plus math 95. But you should be in 115 because you've already completed math 99. Okay.
Okay, Professor. Thank you very much. I was trying to decide because like they almost have the same name and everything. So I was wondering what the main
Yeah, but
difference
when you
was.
look at things, yes, the name is kind of the same, but it's also college versus algebra. I know this sounds, but when things start sounding the same, your biggest giveaway is even if the credits are the same, see how many hours you're spending. Look at that, 7 hours versus 4 hours, right? And then the last thing that I would actually do this first. If two classes seem the same and you're not sure where you need to be, you look at the prerequisites and see which class you had to complete before you can get into that class. And this one is asking for the one that you did already, which is math 99.
Yes, that's because
Okay.
yeah, because I do see it here. They almost have the same timestamp too, because like for example, 117 is like from 10:45, like for an example, 10:45 to 2 o'clock, and then it almost has the same timestamp, 9:15 to 11:30.
Okay.
So they're both about like 2 hours and so they're about like 2 hours each.
That's weird. I don't know
And
what's
then
going on because this is the most up-to-date catalog, unless there's a lab at some other time that, I mean, I don't know. I just don't know what to tell you. All I can say is that you definitely should be in math 115. Don't go to 117. It's a lower level math than the one that you need to be in. And you want to make sure that your credits are transferring. Okay.
yes,
So don't go and redo things. You already went through math 99, which is at a much higher level than 95. So you don't need to be in this class. Okay, you
okay,
need to
yeah,
be in this class.
yes, because I was gonna take my internship during the fall too, but I just got into like this program they're doing, the Goldman Sachs thing.
The fellows thing.
Yes, I just got into it, but so now I'm gonna do my internship in the spring. So now I gotta move things around. So now I gotta do my
Okay.
math in the short semester.
Okay, so be careful because that's gonna be tough. It's 6 weeks of pretty intense math then.
Yes. So I'm gonna be doing two courses, the math and then one Spanish class.
And how's your Spanish? Are you fluent or what's the story with your Spanish?
Oh yeah, I'm fluent in
Okay, so
more
that's not gonna be too hard because I'm just thinking doing an internship plus math plus Spanish, that's I mean, the math and the Spanish is in 6 weeks, and then the internship is a 12-week thing. That's a lot of work.
Yes, no, but the internship is gonna be during the spring semester.
Oh, got you. I got you. Okay, good. Okay,
So,
fine. Okay.
Originally, I was gonna do the spring internship with the with Spanish during the break, but
Okay. But
since
aren't you also working? So you're doing these two classes and you're working in fall too, or what's happening?
yeah, so right now I'm working. I have like two jobs. I have one weekend job that's overnight,
Okay.
and then I just got into like this Amazon warehouse job, and I'll probably keep that around until like the internship starts, and then I'll cut the internship the Amazon job.
Okay, so just make sure that you figure out how much work is in this math class that you don't end up having a problem,
Yeah,
with,
I might end up ultimately just dropping my Amazon job to focus more on the math.
okay,
Because
Okay.
math has always been a challenge for me. So like especially now I'm gonna be doing it in the short term, I'm definitely gonna need to pay more attention.
okay. And is the spring your last semester or no?
Yes, spring will be my last semester.
Okay, so
and,
then you have to be really careful with fall two, because anything that goes sideways in fall two is gonna bleed into spring. And if you're already doing an internship, you don't want to carry another class into fall. I mean, into spring if you don't complete it successfully in fall two, okay?
yeah, I already put in my schedule already built and everything. I already put the GRD code, so the intent to graduate and everything.
Okay, good, good.
So,
Good.
so pretty much everything's starting to set up pretty nicely for me. Any word by any chance from you like on the graduation or for like the this coming year? Nothing like
I haven't
nothing yet?
received any information. There's I think the president has a town hall tomorrow. I just don't think, I mean, and I'm saying this in the kindest way possible, like because of the amount of things that are going on at LaGuardia with just trying to start back up with getting people back to campus. I don't think that, in-person graduation is, there may be people working on it in the background, but from a communication perspective, whether graduation is in person or not has not yet reached like the top of the list of priorities for what they are communicating to faculty at this point.
Mhm. Okay, well,
Okay.
I just hopefully they do
Yeah,
decide to
I
have the
hope so.
in-person graduation.
Okay. All right. Let me, Shafak, did you have a question or it was answered? I don't know. I thought I saw your hand at one point.
Yeah, I did actually. So,
up?
I mean, while you were talking to him, I realized that I took Math 99 too, and then after that, I took Math 120 right away. So that's
Yeah.
okay, right?
Yeah, because Math 120 is statistics. And so, I mean, I'm just going by what John is saying. He wants to register for college algebra, and that's fine. But a lot of business administration students do the Math 120, which is the statistics. Let me go back here just 1 second. I just want to make sure, and thank you for bringing this up, because you guys are John, you're business administration, right?
Yes, that is correct, Professor. I'm not too good with word problems when it comes to math, like mixing word problems and math. Not my best subject. I'm more of a formula person, more of a
So that's why you're going for
equations.
college algebra, you mean?
Yes, because
Yeah.
I'm more better at equations.
Right. So Shafak, you're fine. I mean, Math 120 is in the degree map for business administration or a math required core course. And John is also fine because he's taking Math 115 because he prefers to work with the algebraic equations than to deal with the stats.
Yes, they
Okay.
change. I think I still have one of these printed out. But this thing right here is really good to help you all make your schedule. But they changed it honestly because before they didn't have which one they didn't have. I was looking at this the other day. They didn't have business communication.
Yeah, you got to be careful because this, I know what you mean, but this is, you got to be careful for which catalog year you are in, and this updated thing was starting for people entering in fall 2021. So this business communication course didn't even exist when you started, and you don't have to, you are not required to take it. You basically have to look at what's on the program core for yourself in your degree works. Okay, so be
Yeah, so
careful. I totally understand what you're saying. When I'm pulling this up, this is as of this academic year, but you didn't start this academic year, so you would have been under a previous regime, which did not have business communication, nor did it have this financial planning or
the
individual
capstone.
Yeah, but that's just, I mean, that's just calling a class, I think, that you had before. The BTC 200 you have to take anyway. They're just naming it a capstone.
Oh, the
now.
capstone, yeah, okay. It sounds more. It sounds a little bit more business suited now than before. It sounds a little bit
Mhm.
more difficult. Like,
Yeah, it's the same class. Don't worry.
no, but like in
So-
general, certain classes seem a little bit more difficult because
Let
before
me.
you had a few electives and everything. Now it's a little bit more business focused.
Yeah, because they put some more business class, like the business communication and the financial planning. But I mean, there's not really that much difference. Let me take these other two people, and then I really have to get back to the material. Shafak, what's up?
Yeah, I wanted to say that I'm not from business and administration major. I'm from accounting major.
Yeah, so even for accounting and business, the only two classes that are going to be different is you'll take intermediate accounting 1 and 2, and someone like John, who's a business admin, will take marketing and management. So when we talk about the math class, it's the same. It's the same requirement for business admin and accounting, math 120 or another accounting course.
Now
I
that
mean,
I'm
or
looking
another
at
math
the
course. Sorry.
now that I'm looking at this degree maps for business administration, I
Mhm.
realized that many of the courses are similar to accounting.
They're all
for,
they're all the same. This
major.
is, this is exactly, this is what I'm saying, and I'll just show it here because, I'll show you what I mean. It's literally the same thing, except that you have intermediate accounting 1 and intermediate accounting 2, and John or whoever else will have principles of marketing and principles of management. That's the only two courses different. That's why I sometimes advise students, I also teach a first year seminar, sometimes advise students who are confused about whether they want to do accounting or business administration. I say, as long as you don't yet take marketing and management, you can kind of postpone that and maybe take accounting 2 and then see if you like accounting, then you're still on track, because it's only those two courses that are different between the two programs.
Yeah, I'm done with all of these classes, and
Mhm.
I've accounting 201 for my winter session, and then accounting 202
In
for
the
my
spring.
spring session.
Okay,
Yeah.
great. All right. Okay, so any further talk about the registration and stuff? Happy to talk at the end of the class also. I don't know if I know when you had your hand up. You can ask me at the end if there was something that was still coming up here for you. I don't know, or maybe your hand was just up by accident. All right. So I was also reminded here that I'm supposed to go over the chapter 15 homework, which I forgot about. So let me actually just see time wise, we've still got an hour. So what I'm going to do is close us out on one more example of an operating activities question, and we've got many more. We've got at least 2 more sessions for statement of cash flows. We won't need 2 of them, but I'll do one more example for this operating activities, especially for people who want to start doing the homework. I don't want you to not have enough to work on, and then I'll go over the chapter 15 homework with you afterwards. So let me just go into the questions and I'll show you. I'm going to skip over number 5, which is, working through some T accounts. It's fine, and go to number 6, which is a slightly different presentation of of information to do an operating activities section. And I don't want you to think that the cash flow, it's only operating activities that you're doing. That's not the case. You are doing you will be able to do the full cash flow. It's just that the operating activity section is so involved that it's basically where we spend most of our time, and so it's also where I'm going to spend most of the time for the class. So just hang on, I'm just pulling up my version of the thing also so that I can see it. Okay, 1 second. Let me just get my solution. Okay, so I don't know what's going on with my notes. It's fine. Well, I'll just work it through top to bottom without referring to my notes. It's really not a big deal. We know what number we have to end on, 318,000. So for those who do have this question, I'll read it through. If you don't have it, just try to follow. Zambrand Company's income statement contained the condensed information below. So part of why I'm doing this question is that, in the past now we've been given a lot of balance sheets. We've been given comparative balance sheets or, balance sheet information. The way this question is presented is that they're giving you an income statement and then giving you some critical balance sheet stuff as well. And this ties in with the explanation that I was giving previously when C was asking me about, why are we adding back depreciation and all of those things. You can see how the net income is calculated and then the numbers that we're going to pick out from there. So you see a service revenue, 970,000, operating expenses, excluding depreciation of 624,000. There's the depreciation being subtracted, right? The depreciation expense is subtracted from the 970. The loss on disposal of equipment is also subtraction. These three numbers together come out to 700,000 of expenses and losses. That 970 minus the 700 gives us income before income taxes of 270,000. And then you've got income tax expense. You might remember this from chapter 14, right? That the companies will have tax. You subtract the income tax expense, and so you have a net income of 230,000. So the 230,000 is the number that we will start the statement of cash flows on. And then we already know what our depreciation expense is for adjustment number 1. We already know that there's a loss that we have to add back for adjustment number 2. So now there's just the third adjustment, which is looking at the current assets and current liabilities, the changes in those balances to come up with whether there's increases and decreases. So accounts receivable went from 65,000 to 75,000. So there's an increase there. Accounts payable from 28,000 to 46,000, also an increase. And income taxes payable, which is, a current liability because you're going to pay off your tax owed within the year, goes up from 7,000 to 11,000. So this is the information we need for adjustment number 3. And so it's telling us that accounts payable pertain to operating expenses. All that means is that they're just saying that the change in the accounts payable balance should go into the operating activity section of the statement of cash flows. It normally does anyway. So this information is a little bit unnecessary. Prepare the operating activity section of the statement of cash flows using the indirect method. We already know that the indirect method is the method that we've been using all along, and it starts with net income. The reason I'm speaking about the indirect method here and that we should know that this is what we use already is that sometimes people don't pay attention to this information, and then suddenly when they get to a homework or they get to a test and they read indirect method and then they panic thinking, what what is indirect method, but it's the same thing that we've been doing all along, right? So I'm gonna go between the question and the answer sheet here and go back to where we were over here on the exercises. I'm going to skip right down because I wrote all this stuff on the side here. So when you look at the solution sheet, don't think that something was deleted here. I'm just skipping right down so I don't confuse exercise 6 with some of the explanations from the previous example. So this is going to be a Zambrand, hopefully I'm spelling this right, Zambrand company statement of cash flows, right? And let's see if there's date information. Yeah, for the year ended December 31, 2014. So we'll go with that. Oops. For the year ended December 31, 2014. So it's for a period of time, right? That we explain the changes. And so we start with cash flows from operating activities. Notice how it's the same thing over and over, right? So hopefully the more you practice, the better you become at doing this. And you always start this indirect method with net income. And when you go back to the question and you scroll over here, you are reminded that net income is 230,000, right? So in previous examples, we were given net income number, as part of additional information or whatever year you're expected to know that net income is part of the income statement. So it's 230,000. Now we do the adjustments to reconcile, blah, 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 right? To reconcile net income to net cash provided by operating activities. I am just going to copy and paste that. It's likely in Wiley that they will already have that written in for you, but all that means is you're just saying, what do I need to add to or subtract from net income to get to net cash? And we know it's the 3 adjustments that we spoke about before. So adjustment number 1, here goes your depreciation expense, right? And when you go back, the depreciation expense is part of the income statement. There's the 60,000. That's the number that you use. Questions up to there, anybody? All right. Okay, so adjustment number 2, you can, or, I'm skipping spaces just so it's easier for us to read what we did. You don't have to skip lines. So there's the loss on disposal of equipment, right? So the second adjustment says that you add back any losses or deduct any gains. So this is a loss, so we're going to add it back, right? So add in the textbook, it's just going to say loss on disposal of equipment. I was going to write add, but I'll just show you by not using, a minus here. So 16,000, you're going to add 16,000. And then adjustment number 3, now we come to the changes in the current assets and current liabilities. So we go back here and we look to see what's what. So accounts receivable went up by 10,000, right? So there's an increase in accounts receivable of 10,000. So if we go into robot mode, right, as we were calling it, robot mode tells us when there's an increase in a current asset, you will subtract. Non-robot mode says if accounts receivable increased, it means that we did not collect money from our customers, but those amounts are in revenue. So we have to take them out because revenue is too high by this amount of accounts receivable that was not collected. So this is a minus 10,000. So I'll repeat for the people who are holding on and trying to figure out what this means. When your accounts receivable goes up, it means that you earned revenue, but you didn't collect it in cash, right? Because it's still owing at the end of the year. So the revenue number in here is including all cash and all receivables revenue, but we want to get to the actual cash that was collected. So this 230,000 includes 10,000 of revenue that was actually not collected. in cash, so we have to take it away.
But Professor, I thought it's an asset, so it's in the balance sheet. It's not even related to the net income.
Well, accounts receivable is an asset in the balance sheet, but remember, revenue is part of the income statement. So here we're saying this is going the opposite direction of what we had before, right? And remember, in this question, there was a decrease in accounts receivable. And so I told you that it was because there's a collection, right, of accounts receivable. Let me see if I can explain this one. Over here, what's happening is and accounts receivable is a balance sheet account, but there's more to it than that. So over here, what's happening is the net income includes some type of revenue, obviously, right? So let's just say, I'm just trying to think of making up numbers here that will make sense. So let me see. Let's just say we have revenue, and part of the revenue is collected in cash, and part, let's just say it was one transaction for the year, okay? And the revenue amount, I'm just gonna make up an amount, is 200,000. Okay, so revenue goes up on the credit side. Let's then say that 190,000 of that was collected in cash and 10,000 of it is accounts receivable. Okay, in the income statement, you have the full 200, and in fact, I think we have a revenue number. Sorry, I can actually go with this 970,000, pardon me. I'll just go with the actual revenue number, 970,000. So we'll say 960,000 was in cash and the other is accounts receivable. I'm just trying to match the question. So the income statement picks up the entire revenue amount of 970,000, all right? But some of that amount was collected in cash, and some of it is still sitting in accounts receivable at the end of the year because the number has grown by 10,000. So 10,000 of accounts receivable exists, but the income is acting as if this entire amount was collected already, right? Because the 970 in its entirety is in here, increasing your net income. So we're saying, hey, the net income has 970,000 of revenue, of which only 960 was collected in cash. So the 10,000 that wasn't collected in cash needs to be deducted. That's what's happening. So even though accounts receivable is a balance sheet account, it's giving us information about how much revenue was collected in cash and how much wasn't. All right.
Yes.
Okay. This is why I said, it takes a few go-arounds, because depending on whether it's an increase or decrease, things can get a little bit crazy again. All right. So accounts payable goes up from 28,000 to 46,000. So so we end up asking ourselves, what does that mean, right? That means that you did not pay off some of your payables by 18,000, right? You didn't pay off some of your payables. So if we go into, again, this kind of like, what does the rule say, right? When there's an increase in current liabilities, you add it back. That's the rule. So we can go by the rule, increase in accounts and it's 18,000, so we're going to add it. So now the question is, but now why is this an addition over here, right? Because again, your net income, right? If you go back to the question, since this question is actually giving us an income statement to look at, this net income number is including expenses somewhere in this 624,000, right? There's expenses that are all being subtracted from the revenue to get to net income, but 18,000 of those expenses were not actually paid in cash. So the way you think about it is like this. You say debit expenses, right? And if you go to the question, the expenses, I'm just working with this, 624,000. So all the expenses for the year, 624,000. For cash, and then some was left, right? Some was paid in cash, excuse me, and some was left in accounts payable. 18,000 was in accounts payable, and the rest, and I know that because accounts payable went up by 18,000, and the rest was actually paid in cash. So this is what is in, this is in the income statement. right now. You saw it on the sheet. This is in the income statement, just like this revenue was also in the income statement. So the income statement doesn't care whether things were in cash or not. It just picks up the total amount. That's what accrual accounting is. Similarly, the income statement does not care, if these expenses were all paid in cash or if some of them are still owing. It will just pick up the entire expense. So this 230,000 includes the 624,000. We saw it on the question, right? It includes the whole amount, but some of it was not paid in cash. So if we want to know the actual cash that was paid, our expenses cause net income to go down by 624,000, but it should actually only have gone down by 606,000. So we add back 18,000. That's how we think about it. And then, and again, if your brain just melted, that's okay. You just go by the rule, okay? But I'll just keep explaining this because it's, some people are going to wonder why, and you'll get it in the end if you stick with me. Income taxes payable, another liability, right? It went up from 7,000 to 11,000. So it's an increase, just like with the accounts payable. It's an increase, right? Sorry, increase in a current liability. So it's an increase in income taxes payable. So even if we have no idea what that really means, it's going to be in the same direction as the accounts payable because they're both payable. So you're going to add it back, right? What this is saying is that in these expenses, again, there's well, not in those expenses, in this 40,000, in this income tax expense, part of this was paid in cash and part of it is still payable. So I'll show you what the journal entry would have looked like to get us to that point. You would have said income tax expense 40,000. The straight 40,000 is what is in the income statement. So that is what affected your net income, right? 40,000. And then you said some portion of that, specifically 36,000, was actually paid in cash, and the other 4,000 increased your income taxes payable. Right. So when we look at the 230,000, it went down by 40,000. But if we want to know how much cash was paid, it should have only gone down by 36,000. So we need to add back the 4,000 that was never paid in cash. That's how you think about these adjustments, right? I know it's a lot. It will come. We'll just keep practicing. So I think I'm done. I hope I'm done because I'm getting pretty exhausted by my own calculations, right? So you add and subtract these numbers together, right? You pluses and minuses, be careful of the signs, and it's going to come to 88,000, right? I'm not going to do the adding and subtracting because I'm going to end up with dollar signs in places that I don't want it and so on. But the total is 88,000. You're going to say 230,000 plus the 88,000 because it's a positive number, 318,000. That is net cash provided by operating activities. So what's easy about the cash flow, the operating activities thing, is that you can follow the rules and you can still get it right. What's hard about this is if you really want to understand how this works, you have to understand how the income statement and the balance sheet work in order to build the statement of cash flows. That's why it feels hard, because you need good knowledge of all of the, I guess, all of the financial statements in order to build this thing. Questions here? Comments, cries for help? Any of the above?
A little bit of cries for help.
Cries for help. Totally, totally understandable, guys. I am. What can I tell you? This is my honest.
It's definitely something to do, like practice to
Over
get
and
the
over.
hang of it.
And
Yeah.
and that's why I go, you know, in the first two classes, I go over the whole thing. And then after that, we're just going to drill it until it comes. It's the only way, because I can explain these theoretical constructs to you and you can read the textbook and you'll just be like, you know, looking at me with like big Google eyes, like, what are you talking about? But if we do it over and over, it will come. So it's okay if you're feeling overwhelmed, if you're feeling like you want to, like I said, you know, I was kind of joking, but kind of not, like, let's cry in a corner somewhere. I remember when I first had to do cash flows at university as well, I was horrified by what was happening. And, you know, obviously now I teach it and it's fine, but I do remember the feeling. And I will say that the only way to get this under control is to do it. Okay. So I'm going to stop us here now. One, because, you know, I think that we just need a moment for some of these things to settle, but I also do want to honor, you know, going over the chapter 15 homework, especially as people start to gear up to start studying, you know, for the test and stuff. But also because if you're not quite getting this, then, you know, it may feel like we're just reinforcing, you know, the stress of not understanding this. You do have some personal responsibility, and by you, I mean the royal you, as in all of us, to go back and try and see, you know, read up on the work and try and work through these examples on your own. It can't just be the class alone. Some of the topics you can kind of cruise by, you know, being in class and doing some examples, and it's like, it's okay. But this is not something that you can just have, you know, the 2 hours with me and then assume that you know what's going on. You have to read the notes, the textbook, and do some practicing on your own. And I mean, the best way to practice is just to start doing some of the homework questions and see if you know what's happening. That's, you know, that's another option. You can of course rewatch these videos if you are so moved, late night viewing, right? Okay, any other clarification points or anything to do with cash flows before I move into the chapter 15 homework? Okay, so I don't assume that means that everybody knows what's going on. I assume that people still need time, and that's fine. All right, so we'll come back. Let me see what's going on your schedule so that I'm not talking nonsense to you. So we still technically have 2 more sessions of cash flows before we even have to get to chapter 18. So, you know, I will drill it until, you know, you guys beg me to stop doing cash flows. Okay. Again, because there's a big statement of cash flows in the test, and there's a statement of cash flows in the final. So this is not something to be trifled with. Okay, this is not something where you can just say, oh, I don't get it, it's too bad. You're going to lose like 30 or 40% of the grade on the next exam. That's not what you want. Oh, and you know, sorry, I just remembered that for the people who are actually going to be working through the homework, let me see if I include it in my notes. I forgot to mention, oh, I didn't, so I have to go into the textbook. I just want to go over the free cash flow thing. I'll go over the theory behind it, and then next time I will make sure that I do an example. But I just want to close out the chapter. I'm not sure why I don't have this in my notes. I probably just deleted something by accident, or I don't know. Anyway, I'm just gonna show you in the textbook where it is, and I won't do an example right now. I'll do one next time, but just in case you're concerned when you are reading the chapter about whether this is actually included or not, it is part of the work. What's happening? Yeah, okay. Yeah, so this is under analyzing the statement of cash flows, and specifically part of the work that's called free cash flow. And basically what this is a calculation that you can do to see how much cash the company actually has available, to just as kind of like how you would have disposable income. And why do we care? Because often when companies, one company wants to buy another company, they want to see, okay, how much cash are you making through your operating activities? That's what we've been calculating all along, right? And then are there any payments that are coming up where you have to pay for things like equipment, machinery, and so on? We want to know, how much of capital expenditures, that's what it's called, right? Assets that you're going to have to buy in the future. That's kind of like a must, right? It's replacing, maybe like in this example, we're going to have to buy equipment or something for our business. And then also often companies, and you know this from before, companies pay dividends. And so when someone is looking at the operating activities cash of a company, they realize that, if a company consistently pays dividends every quarter or every year or whatever, then you also have to account for the cash that has to go towards dividends. So they're actually just trying to see how much money is left at the end, right? After, so we generate, X amount of, and this is the example over here. Also, you can see it, but for the formula, let's just focus on the formula. You can say, okay, you generated $1 million in cash from operating activities, but of that amount, we know that you have to replace your machinery, and that's going to cost you $200,000, and we know you're going to pay another $300,000 in dividends. So really, the true cash that you have free to use in your company is $500,000. So that's all that was really left in the chapter that I didn't speak to right now. And there's an example of Apple. We'll come back to all of this next time. I just wanted to mention this in case people were reading the book and they're like, wait, we didn't discuss this. Is this part of the work or not? It is, and we'll do an example next time. What's happening? Okay. No, we're not going over chapter 18 in the next class. I think that's what you were asking me. So now that I'm here with in Wiley, let me go into the homework. And see if I can knock this out in I guess 30 minutes or so. This is like tiny. Okay. So, I'll just go question by question. Obviously, already. Oh, I know why it was so small now, because I was trying to get stuff onto the same screen. You know already that my numbers are not going to be the same as yours. You can take a moment if you like to open up your homework on another screen if you have another screen available. Otherwise, feel free to just follow along with with what I'm saying in the hopes that if there are questions, they can be answered through this process. So we're taking a step back. So let me just have some water. We're taking a step back into chapter 15, which was long-term liabilities. It's all the bonds payable, the mortgage payable, and those things that we did before. And so this first question, Crane Corporation issued 3,200, 6%, 5-year, $1,000 bonds. So remember, we spoke about the fact that the bond may either be quoted as a big amount, one amount, or it's multiple bonds that are issued for smaller amounts. So what ends up happening here is you have to do 3,200 multiplied by 1,000. That is the face value. So it's 3.2 million is the face value of the bonds. 6% is the annual interest rate, 5 years is the term, the life of the bond. It's dated January the 1st, 2022, and it's at 100, which means that there is no discount and there is no premium. Interest is paid each January 1st, which means that it's annual interest paid once a year. So the journal entry to record the sale of the bonds on January the 1st, you debit cash with the face value, again, $1,000 times 3,200 bonds. And you credit bonds payable, 3.2 million. Raise your hand or shout out if you have any questions for me while I go through this. All right. So how are we going to calculate interest? You have a 6% interest rate on 3.2 million. All right. And I'll show you over here. Hopefully this will open. That's all it is for my example. And so it says prepare the adjusting journal entry. So you have to be careful, read this properly. On December 31st, 2022 to record interest expense. Remember the question said that interest is paid each January the 1st. Of course, interest is not going to be paid on the first day of the bond because no interest has been accrued. But if they're asking you for interest at December 31, then it's still a payable to be paid. If it was on January the 1st, it would be cash as the credit. So we debit interest expense with a 192,000 and we credit interest payable. Prepare the journal entry on January the 1st, 2023. So here's the cash to be for the interest to be paid, debit interest payable, the same 192, you're getting rid of the liability and you are crediting cash. Questions, anybody? All right, I move on. This is some of the more basic stuff, so I'm going to keep it moving. On January the 1st, 22, Ivanhoe Company issued 445,000. So this is a single amount, not, multiple bonds with small amounts. $445,000, that's the face value. 14% is the annual interest rate. 10 years is the term at face value. So there's no discount, no premium. Interest is payable annually on January the 1st. Prepare the journal entry to record the issuance of the bonds. It's the same thing as what we just did, right? You receive the cash and you have a liability for the 445,000. You don't need to do anything with the interest rate on the first day over here, right? You're not recording interest or multiplying anything by 14%. You're just recording straight 445,000. Prepare the journal entry to record the accrual of interest. So it's the same question, again. And here you can see from the solution, very basic. It's the face value times the interest rate. Because they're only paying interest once a year, there's no multiplying by 6/12 or divided by 2 or multiplying by some, half of the percentage. You're just saying face times the interest rate, debit interest expense, credit interest payable. All right. And the last one now, paying the interest on the next day, interest payable, debit, the liability goes away, and cash credit. So the first two questions are basically the same thing. Any comments here? Anybody? Okay, so I'll keep it moving. Blossom Company issues $1 million. There's the face value, 10-year term, 10% annual interest rate bonds at, okay, 95. Things are getting a little bit more interesting. Since it's below 100, this bond is being issued at a discount with interest payable once a year, January the 1st. Prepare the journal entry to record the sale of these bonds on January the 1st. So you remember that cash is going to be the amount, the discounted amount. So it's going to be $1 million times 95% because that's what you're actually receiving. Bonds payable always goes in and out at face value, right? So no matter what, bonds payable is going to be $1 million in this example. Cash is what you actually receive. So it's the 95%. And then the discount on bonds payable, right? That contra liability account is the 50,000, the difference between the cash that was received and the bonds payable liability. So classic discount on bonds example. What happens over here, assuming that, that the above bonds are sold for 108, so they're trying to check now if you know how to do a premium. It's above 100, so it has to be a premium. Prepare the journal entry to record the sale of these bonds. So 108 is the cash, so cash is going to be $1 million times 108%, so it's $1,080,000. Bonds payable in at face value, and the premium is a credit balance of 80,000. Right. So remember, when it's a premium, the cash is higher than the bonds payable face value. Questions on the discount and the premium? Palomar Company issued 1,670,000 of bonds on January the 1st. Did I forget interest on this previous question? Why do I feel like they didn't ask for it? They just mentioned it, but they didn't actually ask. Okay, so they issued 2,050,000 of bonds on January the 1st, 2022. So this is taking you through again, the bonds are issued at face, the bonds are issued at a discount, the bonds are issued at a premium, right? So multiple draws of the same stuff, you can already assume that something like this is going to come on the test, right? You need to be able to make these journal entries. So when the bonds are issued at face, it's a straight debit cash, credit bonds payable. This is the face value. There's no discount, no premium. When it's 97, it means that the cash that you are receiving is 97% of the face value. So that comes out to, and I'll open the solution here so that you can see that 2,050,000 times 97% is the 1,988,500. The bonds payable again goes in at face. So the difference between the cash you received and the bonds payable is going to be the debit discount on bonds payable of 61,500. If you can remember for these questions that bonds payable is always going in and out at face value, it's going to help you to figure out the rest of the journal entry. All right. And then it says that the last part is that the bonds are issued at a premium. So 2,050,000 cash times 1.05 or times 105%, however you prefer to do it on your calculator. So that's going to be more cash, right, than the face value of the bonds because you sold it for more than face. So 2,152,500, that's the cash. Bonds payable again in at the credit of face value, 2,050,000. And so the difference, this is a plug number, right? Plug to balance the debits and credit dollar amounts. The difference is the premium on bonds payable for 102,500. Questions on 1 through 3? Okay. And here, prepare the journal entry to record the redemption of the bonds. Critical information. At maturity, assuming the bonds were issued at 100, even if the bonds had been issued at the discount or premium, if it's a redemption at maturity, it means that everything is going to be at face value. And remember the redemption journal entry. Here's the issuance, right? Debit, cash, credit, bonds payable. The redemption journal entry, you just flip. You flip it over. You debit the liability because it's going away, and you credit cash because you're paying out the cash to the people who lent it to you before. Questions on redemption? Okay. Now we come to, the thing that people usually, I told you this, that people usually mess this up on the tests, the redemption before maturity, and we did a few examples of this, right? So prepare the journal entry to record the redemption of the bonds before maturity at 97. The at 97 tells you how much cash you are paying, all right? Assume the balance in the premium on bonds payable is 9,800. I gave you in the notes 3 steps that you need to follow for redeeming bonds before maturity. The first step is that you have to remove the carrying value of the bond, and that means that the bond payable that is normally a credit balance has to be debited. In this case, you've got a premium on bonds payable that is also normally a credit balance. You will have to debit the balance. So you can see in the first step here, bonds payable debit because you're getting rid of the liability. Premium on bonds payable, this credit balance also has to be removed because you are removing the entire carrying amount of the bonds. Cash is calculated as the 97% of they don't show it over here, but it's, it should make sense that 97% of the face value of the bonds. Okay, so 2,050,000 multiplied by 97%, that is how much cash you are paying out. And then I told you that in the third step, you compare the cash that you paid to the carrying amount of the bonds, right? And if you pay more cash than the carrying amount, it's a loss. And if you pay less cash, it is a gain. So the carrying amount of the bond was 2,059,800, right? Because it's the 2,050,000 plus a 9,800 premium. That was the carrying amount. You owed 2,059,800 to your lenders, whoever lent you the money. You only paid them 1,988,500. That means that you paid less for this debt than what you actually owed. So that is a gain. And the gain is the difference between the carrying amount and the cash. 71,300. A gain is a credit. Okay, a gain is a credit. Now let's just be clear that you can also get to this answer by just, balancing the journal entry. If you know these two debits and you know this credit, you can just say the total of the debits minus the credit for cash also gives you the gain on redemption. And you just have to remember that since it's a credit, it's a gain amount. So that's another way of how you could figure out this answer. I'm going to stop here and check for questions, because again, this is normally where things go sideways for people in the test. Okay. So here we have another a redemption, another redemption question. You can see that it's a redemption before maturity because there's still a discount on bonds payable balance. If it had been at maturity, that discount on bonds payable wouldn't exist, all right? It wouldn't be there. And another giveaway that it's a redemption before maturity is that the bonds are being redeemed at 104. If it's a redemption at maturity, you would just redeem it at face value, okay? So the balance sheet for Oriole Consulting reports the following information on July the 1st, 2022. The face value of the bonds payable is 4.5 million. The discount, which is usually a debit balance, is 180,000. There's a carrying amount of the bond of 4,320,000. Oriole decides to redeem these bonds at 104. After paying annual interest. The 104 is telling you about the amount of cash that's paid. Again, you follow the 3 steps. The first step is that you have to get rid of the carrying amount of the bond. So you will debit bonds payable. It's usually a credit balance, so you debit it. You will also credit discount on bonds payable. It's usually a debit balance, so now you have to credit it to get rid of it. I suggest with questions like this, you write it out on a piece of paper first and figure it out, and then put it into Wiley. I know you guys have done with the homework, but I'm just saying in general, because they always want the debits first and then the credits, but we know that discount is a credit. Then cash is 104 of the face value. So it's 4.5 million times 104%. So the cash that you pay is 4,680,000. I know that your numbers are different to mine, but the mechanics are the same, right? So the face value times the percentage. So 4,680,000. And then you say to yourself, okay, I owed 4,320,000. That's my carrying amount. I paid 4,680,000. So I made a loss because I paid more than what I owed. I paid more by 360,000. So there's a loss on redemption. 4,680,000 paid, 4,320,000 owed, overpaid by 360, it's a loss. Otherwise, if you don't know how to calculate the loss that way, you just balance out your debits and credits, and you will see that you still need a 360,000 debit, and you have to remember that a loss is a debit. Questions? So there are 2 independent situations. For each independent situation, prepare the appropriate journal entry for the redemption of the bonds. Blossom Corporation redeemed 122,500 face value. So that's what the bonds payable balance is. 13% interest rate bonds on June the 30th, 2022 at 102. So that's the cash, right? Cash is going to be 102 times 122,500. The carrying value of the bonds at the redemption date was 110,000. If the carrying value is less than the face, it means that the difference is a discount. Okay, on bonds payable. Specifically, the discount is 12,500. I repeat, face value is 122,500. Carrying amount is only 110,000. So the difference is a discount of 12,500. So there would have been a debit discount balance of 12,500. And then the bonds pay annual interest, and we're not really worried about the interest because it's been made and recorded. So we have to do a redemption before maturity again. So what do? We remove the carrying value of the bond, we calculate the cash to be paid, and we calculate whether there's a gain or a loss. Bonds payable is going to be debited with a face value, 122,500. We know that there's a discount on bonds payable of 12,500. That's going to be credited because this is a normal debit balance. So we will credit it now, right? Cash is going to be 102% of 122,500. Let me see if they do that calculation. Yeah, 122,500 times 102%. So the cash paid is 124,950. That's a credit because cash is being paid out. And then you're saying, okay, I owed 110,000. I paid 124,950. So I have a loss of 14,950 because I paid more than what I owed by 14,950. Okay, that's how you think about the gain and the loss. They're doing the same thing, right? You paid 124,950, you only owed 110,000 because this is the carrying amount of the bond. And so 14,950 is your loss. The other way to do this is just to balance the journal entry and plug the loss number, and you have to remember that the debit amount is a loss. Questions on that one? Okay. And then Testovi, or however you say that, Inc. redeemed 150,000 face value. So that's the balance in bonds payable, 17% interest rate. We don't really care because we're not calculating interest right now at 98. Okay, so cash is going to be 98% of 150,000. The carrying value of the bond at the redemption date is 151,650. So because the carrying amount is more than face value, that means that there was a premium on the bond that was still, there was still a premium balance of 1,650, a credit balance, premium balance, right? So when we remove the carrying amount of the bond, we will have to get rid of that premium balance as well. I'm just comparing the face value to the carrying value to see whether there's a discount or premium. You have to remember that carrying value is defined, right, as the face value or bonds payable plus the premium or bonds payable minus the discount, the face value of the bonds payable. So we're going to remove bonds payable, debit 150,000. We're going to remove the premium. The premium is usually a credit balance, so we debit it with 1,650 to get rid of it. Then we're going to put cash of 98% of 150,000. That's 147,000. And then we say to ourselves, we paid 147,000 for a bond that had a carrying amount. So we owed 151,000. So we actually paid less than what we owed. So that is a gain. Okay, that is a gain, 4,650. Another way is just to plug the gain for the debit and the credit dollar amounts to balance. Questions on that one? All right. Oops, sorry. Instead of clicking the next thing, I click stop share. All right. Let's see how far I can go. I know I'm running out of time. Anything that's left, I can keep going, or I can do it next time. So now we move into mortgage payable. Ivanhoe Inc. issues an 870,000. So that's the principal amount. 10% is your annual interest. 10 years is the term. The mortgage note on December 31st, 2022 to obtain financing for a new building. The terms provide for annual installment installment payments of 100,000. So that's the cash that's going to be paid. Prepare the entry to record the mortgage loan. So that's for the 870,000 and the first installment payment that is on December 31, 2023, right? The next year, because it's annual installments. So here you're going to debit cash with 870,000 because we're receiving the cash and we are creating a mortgage payable liability of 870,000. And then when it comes to the first installment, they're actually showing you the amortization table, the first line. Remember, the first balance is what we actually got, right? The cash, 870,000. Then we have to include the cash payment as the first column, I guess, of the or the first numbers column of the amortization table. It's 100,000. Interest expense is going to be the carrying amount multiplied by the interest rate. So it's going to be 870,000 times 10%, so 87,000. And then the reduction of the principal is the difference between these two numbers, 13,000. We've spoken about this before, that in the first few years of the mortgage, the bulk of your money is going to interest, right? So we know that we're paying cash. So cash is 100,000 credit. Interest expense, an expense goes up on the debit side. So it's 87,000 debit. And then the mortgage payable goes down by the 13,000 that we calculate as the reduction in principal. Questions there? I think it was just that one piece, yeah. Okay. Right. So this is another mortgage, but now you're doing 2 years, right? Crane Company borrowed 301,000. So there's the principal amount on January the 1st. That's the first date of the borrowing by issuing. So it's, kind of repeating the same thing, issuing this 301,000, 10% annual rate mortgage note payable. The terms call for annual installments, 42,000 on December 31st. That's the cash that you will pay. Prepare the journal entries for the mortgage loan in the first 2 installments. So it's a repeat, right? Here goes your cash and your mortgage payable. This is a teeny tiny. Debit cash, credit mortgage payable, no surprises there. Then let's see if they give you another, they're feeling, I guess, a little bit lazy here. So they're giving us an amortization table, but you can kind of figure it out. Cash is going to be a credit of 42,000 that's given in the question. It will always be, the same. And then how do we calculate interest expense? You're going to take 10% of the beginning balance for that first installment. So 10% of 301,000 is 30,100. Right, that's your interest expense, and the reduction of the principal is the difference between the cash that was paid and the interest. So 11,900 is the amount by which your mortgage payable goes down. All right, so you could fit this into an amortization table as well, or you could do it the way they did it here, which is just to show that your interest is 30,100, and of course the difference has to go to the mortgage payable. Questions on that one? Okay. So then the second one, cash stays the same. As you can see, the new principal balance is the 301,000 that we started with, and you subtract the piece of the mortgage payable that you paid off in the first installment. So subtract 11,900, and then you still multiply that new principal balance by 10,000. I'm sorry, 10,000, 10%. So that's 28,910 is your interest. Notice how your interest is dropping because the principal balance is decreasing. So interest is 28,910, and then the difference between the interest and the cash is the 13,090 mortgage payable. So that's the question on the second question on mortgage payables. Let's see how far I can go. Let me try and explain this one, and I may have to leave the last one if I'm going to go over time. Okay. So Blossom Inc. is considering 2 alternatives to finance its construction of a new 2 million plant. Sorry, this threw me off, because 200 million. Issuance of 200,000 shares of common stock at the market price of $10 per share. So that will give them $2 million, or issuing a 2 million 8% bond at face value, right? So, you know, it's which one is better for them is what they're asking. So income before interest and taxes for both scenarios is the 710,000. What we're trying to do in this question is to show, you know, the impact, the different impact that borrowing has on your income versus issuing shares. Remember, with bonds, you've got interest expense, whereas when you issue stock, there's not going to be interest expense. There will be you won't be able to deduct interest expense. So 710,000 is where you start. If we look at the stock scenario, there's no interest expense from bonds, so your income before income taxes is still 710,000. They assume a 40% tax rate, so you multiply the 710,000 by the 40% to get to income tax of 284,000. You subtract that income tax from the income before income taxes to get to a net income of 426,000, and then this number of outstanding shares, right? What's happening here? Because they're saying they're issuing 200,000 shares. If you look on this side, it looks like they had 510,000 shares to begin with. Now they're issuing an extra 200,000 shares. So the number of shares goes up to 710,000. So your earnings per share is, and this is a calculation we've done before, the earnings per share is 426,000 divided by 710,000 gives you a 60 cents earnings per share. Okay, so if you issue 200,000 shares, your earnings per share is going to be 60 cents. What if you issue a $2 million bond, right? You are able to get 160,000 interest expense deduction. Sorry, I lost the word there for a second. Deduction. How do we get that? That's 8% of 2 million, right? Is 160,000. So you subtract the 160,000 from the 710,000. That's an extra expense basically of 550,000. So, but because of that, your income tax expense gets a little bit lower, because 550,000 times 40% is 220,000. So you end up with net income of 330,000, but because you have fewer shares outstanding, you actually end up with a higher earnings per share under the bond issuance than you do under the stock issuance. So indicate which alternative is preferable. Net income is higher if stock is used. However, earnings per share is lower than earnings per share if bonds are used, because of the additional stocks that are outstanding. So it really just depends on what the company, you know, is wanting to do. What do they value more? They could have a higher net income now, but they actually have more shares outstanding, so earnings per share is going down. But remember, with a bond, you always have to have that interest expense, one, and two, you have to pay the 2 million back at the end of the life of the bond, whereas with stocks, you don't have to pay the stocks back, right? So it's really dependent on what the company's goal is in the long term. It's not just about earnings per share in the short term, it's actually about what is the company's goal in the long term. Do they want to be stuck with 2 million that they have to pay back in a few years' time? Questions on this one?
I just don't understand the outstanding shares of the issue bond. How is it related to the, why do we add it to the outstanding shares of the issue stock? Yeah.
So what you have to assume here is that the company has 510,000 shares outstanding before they do anything. This question would have been written better if they had written over here, the company has 510,000 shares outstanding already. Yeah. Right?
So
they didn't do that.
Put it under issue bond.
Because the shares outstanding exist, whether you're issuing stocks or bonds, that happened before
Okay.
this new scenario that we're looking at. That already happened. That's the assumption that it already happened. So you can't assume that in this issue bond, you're only looking at this issuance. You're actually looking at the whole company. And what they're saying is that the company already had 510,000 shares outstanding before they do any of A or B.
Okay, yeah,
Mhm.
that's a question that I had
Yeah, I feel like
last class.
I
It was
know
confusing for
this.
me.
I know this question, and I feel like they would have done better to write this question with just one more line that said 510,000 shares were outstanding before the
Mhm.
company even considers any of the two alternatives, and that's why the shares outstanding become 710 when they issue the extra 200,000 shares. Okay, so
Will we see something like this in an exam?
I didn't know, this is not in the exam. This is for you to understand. Look, you still have to, I mean, you could be asked to, I want to be careful now. You could be asked to calculate earnings per share, right? Not like
Mhm.
this. I just mean in general. You could be asked to calculate bond interest. You know, you could be asked to calculate net income. This is all part of things that we've done before. But did I set it up in the test where you have a comparison between, and you could also have a multiple choice question that says, you know, if you issue bonds, like what are the benefits or whatever, and you know, interest expense and so on may come up. But did I set up a question exactly like this where you have to compare the two? No, that is not on the test as an
perfect.
exercise. Okay.
That's good, thank you.
Yeah, this is, you know, to just round this out. I know I'm going to go 1 minute over, but this piece is really simple, guys. You have multiple examples in the chapter of how the balance sheet should look for long-term liabilities. The only thing that I'd warn you is interest payable is not a long-term liability. It's a current liability. It will always be a current liability. So that's why you don't see it show up in the list of items. Okay, bonds payable is listed first. The premium is added, right? Premium is an addition, so that's why the carrying amount is more than face value. And then you just add the lease liability and then you total. That's it for this last question. So again, the warning is just interest payable is not a long-term liability, so it shouldn't be in the balance sheet. And secondly, if it's a premium, you add. If it's a discount, you subtract. Okay, so that concludes the exercise, not exercise, the chapter 15 homework. If people still have questions, I have office hours literally starting at 1 o'clock, or I can stick around on the call. But other than that, you're dismissed, and I will speak to you next week, Tuesday. All right?
Thank you, Professor. Have a good
All
day.
right. You too.
Thank you, Professor. Have a good one.
You too. Bye-bye.
Thank you, Professor. Have a good one.
Bye. You too.